Bitcoin. This is the original cryptocurrency that started it all back in 2009, created by an anonymous person or group known as Satoshi Nakamoto. It was designed as a decentralized alternative to traditional government-issued currencies, operating on a peer-to-peer network without the need for banks or middlemen. What makes it unique is its strict scarcity, as there will only ever be 21 million coins in existence, which has led many people to view it as a digital version of gold. It matters because it proved that a secure, trustless digital asset could actually work, laying the entire foundation for the modern crypto landscape. Ethereum. Launched in 2015 by Vitalik Buterin, this platform took the blockchain technology behind Bitcoin and expanded it far beyond just simple money transfers. It introduced the concept of smart contracts, which are self-executing agreements with the terms directly written into code. This innovation allowed developers to build decentralized applications, meaning Ethereum acts less like a currency and more like a massive, global, programmable computer. Its native token, Ether, is used to fuel these operations, making it the backbone of decentralized finance and digital ownership. Stablecoins. These cryptocurrencies were created to solve the massive price volatility that makes assets like Bitcoin difficult to use for everyday transactions. They achieve this stability by pegging their market value to an external reference, most commonly a traditional fiat currency like the US dollar. Some are backed by actual cash reserves in a bank, while others use complex algorithms to manage their supply and maintain the peg. They matter immensely in the ecosystem because they provide a safe haven for investors to park their funds without leaving the crypto world entirely. Meme coins. This category includes tokens like Dogecoin and Shiba Inu, which began largely as internet jokes or community-driven projects rather than serious technological innovations. Dogecoin, for instance, was created in 2013 featuring a popular dog meme, intended to mock the wild speculation in the early crypto markets. Despite their light-hearted origins, they have occasionally gained massive real-world value and passionate followings driven entirely by social media hype and community culture. They represent the cultural, speculative, and unpredictable side of the digital asset world. Governance tokens. These are specialized cryptocurrencies issued by decentralized protocols to give voting rights to their holders. Instead of a centralized board of directors making decisions for a project, anyone holding these tokens can propose changes or vote on how the platform should be run. This model shifts control directly to the users, allowing for a democratic approach to software development and financial services. They are vital for projects aiming to achieve true decentralization, turning users into active stakeholders. Privacy coins. These are cryptocurrencies engineered specifically to hide the details of transactions, providing absolute anonymity for users who want to keep their financial activity private. While assets like Bitcoin record every transaction on a public ledger where anyone can trace the flow of funds, privacy coins use advanced cryptography to mask the sender, the receiver, and the amount transferred. Projects like Monero and Zcash pioneered this technology, filling a specific niche for users who prioritize financial confidentiality above all else. They matter because they challenge the transparency model of traditional blockchains, sparking constant debate around financial freedom and regulatory compliance. Layer 2 tokens. These digital assets belong to networks built directly on top of an existing blockchain, like Ethereum, to help it handle more transactions at a lower cost. As major networks became incredibly popular, they suffered from severe congestion and high fees, making them impractical for smaller everyday transfers. Layer 2 solutions solve this by bundling thousands of transactions together, processing them off the main chain, and then sending a single summary back to the secure Layer 1 network. Tokens like Polygon and Arbitrum power these scaling systems, making blockchain technology fast enough and cheap enough for mainstream adoption. Exchange tokens. These are utility cryptocurrencies issued directly by centralized crypto exchanges to incentivize users to trade on their platforms. Holding these tokens usually grants investors significant discounts on trading fees, access to exclusive token launches, or higher cashback rewards on crypto debit cards. The most famous example is Binance Coin, which started as a simple fee discount token but eventually grew to power an entire independent blockchain ecosystem. They matter because they bridge the gap between traditional corporate incentives and decentralized economies, tying the token's value directly to the success of the underlying business. Central bank digital currencies, often abbreviated as CBDCs, these represent a government's official shift into the digital currency space, issued and regulated directly by a nation's central bank. Unlike decentralized cryptocurrencies that operate without a central authority, these are fully centralized and serve as a digital version of a country's fiat money, like the digital dollar or digital yuan. They utilize blockchain-inspired technology to make payment systems faster, safer, and more efficient, while allowing governments to retain full control over monetary policy. They are highly significant because they represent the traditional financial establishment's response to the rise of independent cryptocurrencies, real-world asset tokens. These digital assets, frequently called RWAs, bridge the gap between blockchain technology and physical wealth by representationally tying a token to a tangible off-chain asset. Traditional investments like real estate, gold bullion, private credit, and government treasury bonds are placed into legal trusts and then issued as digital shares on a blockchain. This process allows high-value, historically illiquid assets to be chopped into tiny fractions that anyone in the world can buy, sell, or trade instantly. They matter because they are bringing trillions of dollars of traditional Wall Street finance onto public ledgers, drastically lowering the barrier to entry for global wealth accumulation. Decentralized physical infrastructure tokens, commonly referred to as DePIN, this class of cryptocurrency incentivizes individuals to crowdsource and build real-world physical networks rather than relying on massive telecom or tech corporations. Everyday people buy and host physical hardware in their homes, such as data storage servers, wireless internet routers, or specialized AI computing units, and they earn these native tokens as compensation for providing power and data to the network. Instead of a single company spending billions to construct data centers, the network is built organically by thousands of independent participants worldwide. This model matters because it flips the traditional corporate infrastructure layout on its head, using token incentives to create cheaper, more resilient, and completely decentralized utility networks. Artificial intelligence tokens. These are specialized cryptocurrencies built to fund, coordinate, and power the emerging economy of automated software programs and machine learning networks. Within these distinct ecosystems, the tokens are used as a universal currency for machines, allowing AI programs to autonomously buy computing power, pay for massive data sets, or hire other AI agents to complete specific tasks without any human intervention. They also grant developers access to open-source machine learning models and reward users who contribute raw data or graphics processing power to train new algorithms. They represent a monumental shift in commerce, creating a fully automated machine-to-machine economy where software code can hold its own wealth and pay for its own operational costs. Cross-chain tokens. These cryptocurrencies are designed to solve the critical problem of isolation by allowing entirely different blockchain networks to communicate and share value with one another. Historically, an asset built on Bitcoin could not interact with an application built on Ethereum, trapping wealth inside digital silos and forcing users to rely on risky third-party conversions. Cross-chain protocols and their native tokens act as universal translators and secure shipping lanes, allowing data and assets to slide seamlessly across completely separate ledger architectures. They matter because they transform the fractured landscape of individual blockchains into a fully unified, interconnected internet of value.